I got involved I started in financial planning in 1973, 74. Now, some people haven't been around to remember that was back-to-back bear markets. The market was down 40% in 2 years. So going into alternative investment didn't require genius IQ. I knew I didn't want to have all my money in equities. In those days, the alternative investments weren't known as alternative investments. They were generally limited partnerships in real estate, oil and gas, and equipment leasing. That was about all that was available. My real knowledge in investments, in alternative investments, came when I was chairing the investment committee at Texas A&M University. And one of our trustees, there were only 7 trustees, and one of them was a money manager from Boston. He calls me one day and he said, "Bill, last night I had dinner with one of the trustees from Harvard, and they're doing a lot of things different than we're doing in our foundation. You think we ought to look at it?" Well, we both agreed we should, and we had Cambridge, which is our consulting firm, look at it. And they brought in that thick of research. I mean, I looked at that and said, "You got to be kidding me. I'm supposed to read all that?" I said, you got an executive summary somewhere?" But I did read a lot of it, and I became convinced that was the thing to do. And then through the years, there's been other, Muhammad Al-Erian's book, When Markets Collide, has a lot of great information on it. I ended up chairing another foundation in Dallas, and they were already in alternatives. So from an academic perspective, I got some insights that most people wouldn't have the opportunity to be available. So we use them primarily to level out returns. In other words, we look for things that have discorrelated returns with the stock market, and that's the main reason we use them. And we use a lot. We probably have 5 to 15% of all of our clients invested in that much of their assets in alternatives. When you talk about growth, it's been positive returns. Several of them in double-digit returns. And the other thing is that they have produced those returns in a relatively short period of time. To give you an example, I went into private equity into real estate, and they were able to time their investment. If I'd gone into a mutual fund, all my money would have gone in from day one. As it turned out, we were at the bottom of that market, so I'm not sure it made a lot of difference, but we did very well. Later on, a couple of years ago, with all of my genius, I got in the height of oil and gas, right at the height of the market. But the good thing about being in a private equity investment, they called a minimum, I think less than 1%, about 10% of the commitment that first year. And I still only have about 40% of my commitment in, the rest of it's left out there, which means they've been able to time their investments. Instead of buying it too high, they were able to let it go to the market settle down, and actually got negative in some places before they bought into the different segments of the oil and gas industry that they do. That's one of the reasons I like, private equity is probably my favorite alternative investment. Then you have others like managed futures, which are the most non-correlated asset class to the S&P 500. So that's the reason I really like, one of the reasons I like those type of investments.